I mean, we just went over a lot, Dan. Just comments on what you heard from Steve.
Yeah, regarding the Fed, I personally think it's a little too early to be aggressively pricing in a lot of hikes from here. I don't think that's what the message from the Fed was. But even if
a lot of what? Cuts or hikes?
Yeah, I don't cuts.
Okay, you said hikes.
Sorry. Yeah, I don't think it's a little too early to be pricing in a lot of cuts from the Fed. But even if you do start to get cuts, I do think that the market's reaction is probably a little bit overdone. Name one environment where where the backdrop necessitated cuts, and that was a good time to be invested in stocks. I mean, it generally doesn't happen. I think the guest you had in the prior hour was talking about the same thing. It's like if we're in that environment, you actually want to be sort of focused on high quality companies and stable growth because things are getting worse.
So wait a second, you think the market's reaction yesterday was overdone?
Yeah, I don't think you should be too excited, and I think that's the difference between sort of short-term trading the markets versus longer-term. Yes, the day that you hear any glimpse of a cut from the Fed or easing monetary policy, the market's going to have a nice bump. But if you look over the next couple months, in that environment that necessitates that type of verbiage from the Fed.
Because the economy's weak.
Yeah.
We agree. We think you should be. It could persist for a few days or a few weeks, but in some ways you're getting an opportunity to fade the consensus, right? Because if everyone's believing that things are good, that there's more, call it cowbell, letting the stock market go up, right? That hopefully volatility goes down, protection gets cheaper, and it's something that people can take advantage of.
Do either of you think that the tariffs with Mexico will go on Monday? And if so, what's the impact to the markets? Because you're talking about $1 billion in tariffs on a monthly basis.
Yeah, I don't think anybody knows, right? You have to be more of a psychiatrst than...
I would think the market's going to react pretty strongly one way.
Oh, yeah, absolutely. But, that's why I don't think it makes, at least for our firm, we're not positioning for, these event-driven macro type of events because I don't think most people don't have any competitive advantage in predicting what Trump is going to do one way or the other. I think that, the comments we got from Mexico were pretty, got the markets a little bit excited in one direction, but who knows? I mean, if you get Trump the president on a bad day and he's not liking what he's hearing, you're going to get that 20%, which is not a deal.
But at the same time, you've seen FX change, right? Mm-hmm. And so as the currency weakens in Mexico, the dollar strengthens. What happens there is that maybe it's pricing in for Mexico and their exporters, but people who have to export in dollars, it makes a big difference to them. So you don't have to actually, in our view, play the event, but you could actually just stay out of the way or be careful of those companies that would get hurt if it did happen. And I think you have to think about these things because there is a mix of, call it immigration policy as well as economic policy going on. And as you said, while it might be too hard to forecast, in some ways you do have to think about it.
Yeah, I think that's exactly right. I mean, regardless of the tariffs, I mean, if you can't predict which way the tariffs are going to go one way or the other, I still think that the positioning is the same. I mean, regardless of the tariffs, before the tariffs start to re-escalate, the underlying fundamentals were already starting to weaken anyway. So if you think about profits, they were already starting to slow in pretty much every region of the world. You're getting increasing signs that liquidity is tightening up. And so that's not an environment where you want to be backing up the truck on risk. And the tariffs only reinforce that you want to be focused on more defensive areas of the economy. And
look, it may signal that things are not coming down from the peak, but it doesn't necessarily signal that the end is here.
Oh, absolutely. I don't think that there are signs that we're tipping into a recession just yet. But as Mike Wilson on CNBC yesterday was noting, the risks are increasing. I think even if you look at the Fed's own models, the risks are increasing. If you look at ISM is down at a pretty low level. The market version of that, the PMIs are at a 9-year low. You're having to look at the durable goods orders.
ISM is still 10 points above recessionary levels.
Yeah, absolutely. So nothing we see is pointing toward a recession, but the reality is the underlying fundamentals are getting deeper. Whether you look at durable goods orders, you look at credit delinquencies, all these things are actually going the wrong directions. On top of that, liquidity is actually showing signs of tightening up. Banks are now modestly starting to tighten their lending standards, and this is the first time you've had people worried about the Fed being a little bit too tight, people worrying about the banks now tightening lending standards at a time when the underlying fundamentals are slowing. GDP, had a nice print, but a lot of that came from inventory build and strong business spending, which they're signs of business spending.
If you're concerned about liquidity tightening up, then what the Fed said yesterday does matter.
Right, but Becky, I think one of the points you were making before is that you don't actually have to have a recession to have changes in the stock market, and you can have stock picking. There's more dispersion at that point if growth is slowing, and things can still do well, right? So it's about positioning correctly from a top-down view. and not forgetting about the fundamentals, which I think is your point about having good cash flow, solid balance sheets, organic growth. Those types of things matter, but you can still find winners in that type of market.
Yeah, what does well when the profit cycle is slowing? More defensive sectors and higher quality stocks tend to do much better.